Hello students, this is Ejaz Khan, and in this video we are going to discuss one of the topics of financial management paper of ACCA, and the topic name is certainty equivalent approach. Let us understand this concept with the help of an example. Let's say we have a 3 years project that requires initial investment of $25,000, and after the initial investment each year, it is going to give us different cash flows at the end of each year. $12,000 after the end of first year, then 18,000, and then 15,000. The key point in this information is that these cash flows are not certain. We're not sure of exactly we will be receiving these cash flows or not. Therefore, we only see a 70% probability of getting $12,000 cash flow at the end of the first year. And there's a 30% chance that we won't be getting any cash flows. Similarly, at the end of the second year, we expect $18,000 of cash inflow, but we are only 40% sure of getting it. And there's a 60% chance that we may not be getting any cash flows whatsoever at the end of the second year. And then we have the third year's cash flow with the probability of 80% or 0.8. It means that these cash flows have different certainty levels and hence having different risk level involved. If you just look at the first year cash flow, there's only 30% chance that we may not be getting these cash flows, and that shows the risk. But if you look at the second year's cash flow, there's 60% chance that we may not be getting these cash flows, which shows a higher level risk. So these cash flows have different levels of risk. Additional information given, we have a cost of capital of 12%, whereas we have the risk-free rate of return of 7%. That means investors will be willing to invest at 7% if they see no risk at all. Whereas if there is a risk, they will expect a 12% return. So one of the ways through which we adjust risk in investment appraisal is using a higher discount rate, which is the case here. So wherever investors, they feel that there is a high risk involved, they use a higher discount rate for their appraisal. So one of the ways through which we can solve this question is using these cash flows as our cash flows and discount them at a 12% rate. By doing this, we will be incorporating the risk as we will be using a higher discount rate for discounting these cash flows. But the problem will be the same level of risk will be applied to all these three cash flows, despite having different risk levels involved in these cash flows. So it will be a technical mistake that we will be applying the same level of risk to all these cash flows, whereas each of these three cash flows have different levels of risk involved. So we can use an approach called certainty equivalent approach, where we will be converting these cash flows into risk-free cash flows. And once we are able to convert these cash flows into risk-free cash flows, we'll be then discounting these cash flows at a risk-free rate of return. In that case, all these cash flows will be adjusted as per their risk levels. Let us see how we do that. Let's say we have this cash flow of $12,000 at the end of the first year, and it has a probability of 70%. Now, the $12,000 cash flow, this cash flow of $12,000 has a risk involved. There's a 30% chance that we may not be getting this cash flow. Now, how do we convert these cash flows into risk-free cash flows? Let's take 70% of $12,000. It will be $8,400. Now, if we just look at mathematical comparison of these two, it will be like $12,000 into 70% will be equal to 8,400 into 100%. If you just take 70% of 12,000, it will be equal to 100% of 8,400. These two sides are now mathematically equal. But with the problem with this side is that it has only 70% probability, whereas the cash flows of 8,400 will have the probability of 100%. We can simply say that a cash flow which has a probability of 70% will be equal to a cash flow that has a probability of 100%. And if something has a 100% chance of occurrence, it means there is no risk. So we can simply call 8,400 as risk-free cash flows. Similarly, we can convert 18,000 having a probability of 40% into something that has a probability of 100%. So 18,000 into 40%, 7,200. So we can write it like 18,000 having probability of 40% will be equal to a cash flow of 7,200 that has a probability of 100%. We can simply replace 18,000 with 7,200, and we can say that we're not sure of getting $18,000 as there's only 40% chance of $18,000. But we can replace them with 7,200, and we can simply say that we are very much sure of these cash flows occurring at the end of year 2. So on the left-hand side, we have cash flows that involve risk, whereas on the other side, we have equivalent cash flows with 100% certainty that is no risk. So we are simply converting the cash flows from having risk to no risk. Let's do it for the third year as well. 15,000 into 80%, 12,000. So again, we can write it like 15,000 having 80% chance will be equal to 12,000 having 100% chance. So let me write it here, risk-free cash flows. 12,000 into 0.7, 18,000 into 0.4, and 15,000 into 0.8, whereas the initial investment, it is already very certain, so no need to do anything else. So these are cash flows that have different levels of risk, whereas these are the cash flows, they don't have any risk at all. So instead of using these cash flows and then discounting them at 12% rate, it's far better to use these cash flows instead of these cash flows and use the risk-free rate of return, as we have already adjusted the risk factor accordingly. All the cash flows have been adjusted as per their probability, which means that we have adjusted a risk level accordingly. And now we will be discounting these cash flows at the risk-free rate of return instead of that 12%, because we cannot adjust risk twice. So we have already adjusted the cash flows using probabilities. No need to adjust risk through the cost of capital. So 7% should be the discount rate. So let's calculate the discount factors at the rate of 7% now. For year 0, it's always equal to 1. And for the rest of years, we need to calculate 1 plus 7% raised to the power minus 1 for the first year. So if I just click enter, I'll get the discount factor at 7% for the first year. Now, if I drag this, it will adjust the discount factors accordingly by changing the power sign from 1 to 2 and then from 2 to 3. So now we have got discount factors for each of the 3 years, and let us calculate the present values. And let us multiply the discount factors with the relevant cash flows. And let me drag this so that it applies the same formula to all the cash flows. And let's calculate NPV now and see whether the NPV is positive or negative. So just need to add all these. So it's 1065. So since the net present value is negative, it's better not to go for this project. And this approach where we convert all the cash flows into risk-free cash flows, making their certainty equivalent, that is 100%. This approach is called certainty equivalent approach. Hope you have understood the concept. Thank you for watching, and don't forget to subscribe my channel for more videos. Thank you.